After a 40% rebound in just 2 months, it's tough finding cheap stocks to buy. But that's because you're looking at the market in the wrong way. In this video, I'll show you 3 ways to find cheap stocks, no matter how expensive the rest of the market gets. Then I'll use all 3 to show you the best value stocks right now, as well as the ones you need to avoid. We're talking finding cheap stocks to buy today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, if you're just looking at the stock market, that S&P 500 index, the market definitely does not look cheap right now. The broader market is off its all-time highs set in February by just 5%, while the unemployment rate has tripled and much of the country remains on some form of a partial lockdown. With earnings for companies in the S&P index expected lower by 35% in the second quarter, stocks look like a giant bubble ready to pop. But if you look a little bit closer, looking at the stock sectors and individual stocks, there are still some real opportunities for return. So in this video, I'll show you 3 ways to find cheap stocks to buy, 3 strategies to get the best deal for your money. I'll explain each method and show you how to use it, and then sum it all up to see the 3 cheapest stock sectors in the market right now. We'll start here with one of my favorite resources and comparing the price to earnings ratio for stock sectors. Most likely you've already heard at least 5 times today what the price to earnings ratio is for the stock market. Pundits love to spit this little tidbit out and use it to say that the market is either cheap or expensive. This is the price of the S&P 500 index divided by the cumulative earnings of all the companies. So yeah, an easy way to measure how cheap the market is. But it's also more than a little bit worthless. Just 4 of the 11 stock sectors make up 64% of the market. You're really just getting a skewed picture here. If stocks of tech companies soar like they have been lately, that market PE ratio could be expensive even if the rest of the market is a better value. So if you're going to be using this price to earnings ratio to find cheap stocks, you need to be doing it on that sector level, and there's a perfect resource for this. Now, I've shared the FactSet Earnings Insight report before on the channel. The report is updated every other Friday and shows some great data and analysis on the stock market. The report is totally free, and you can always find it by typing FactSet Earnings Insight into Google, and the most recent version is usually going to be that first result. There are a lot of great graphics and info here, but scroll down and you'll find this graphic for the sector level forward PE ratios. Now that's the current price of the stocks in each sector divided by the earnings that analysts expect over the next year. And you'll see down at the bottom here, you get the current PE ratio along with the 5-year and 10-year average for each sector. So for example, on the far left here, we see the stocks in the consumer discretionary sector are trading for a mind-blowing 44.6 times earnings, which is more than double that 10-year average of 17.9 times. Next to that here are the stocks in the industrial sector trading for 25.2 times earnings, which is 63% more than the average P multiple of that 15.4 times over the past 10 years. So definitely confirming that idea of a very expensive stock market. But if you look at the few of the sectors on the right, it's a totally different market. Stocks of financial companies like banks and insurance are trading for just 15.1 times earnings, which is still about 24% more than that long-term average of 12.2 times, but not nearly as bad. And some of these other sectors like healthcare, utilities, and consumer staples are even closer to their 10-year averages. So if you're looking for broad, diversified investments, it's a great way to find those sectors that are trading for relatively less expensive compared to the others. If you're looking for those individual stocks, it's also a good start, finding those cheap sectors, then drilling into each to find the best stocks to buy. Another method here is to take some of the financial ratios like that PE ratio or other fundamentals and then compare them across stocks. So here I'm talking about finding things like the PE ratio or other price multiples for valuation. You can use ratios like the operating margin for efficiency and then debt to equity ratios to measure that risk, and you can compare them across different stocks. Now, just about any investing platform or even here on Yahoo Finance is going to have a page to show you some of these ratios. The problem though is I've never found a resource comparing the ratios for each stock against the average for its sector. So a way to see if a company is doing better or worse compared to its business group. In fact, it got to the point where I just had to create this resource myself and add it to my own spreadsheet tool. Using the resource, I can put in 2 stock symbols and the spreadsheet's going to automatically download that information from the internet along with these 10 financial ratios for each stock. And what I really like about this is that's going to show me the ratios for each stock against the average for its stock sector as well. So here we have Nike and Under Armour, both consumer cyclical stocks, and I see the PE ratio as well as price to sales, the profitability measures like operating margin and profit margin, and then some return ratios as well. Besides being able to match these stocks against each other, I can see how each stacks up against the average for its sector. I'll leave a link in the description below this video to download this spreadsheet. Besides that stock comparison tool, it's also going to help you track your investments and help planning in your goals. But back to that strategy, and you can do all this without the spreadsheet. I could easily go to my E-Trade account here, click over to Nike, and look up some of the fundamentals. Then I would just have to click back and forth to compare Under Armour or some of those other stocks in the sector. Another way to compare stocks to buy on that sector level is by comparing those recent returns versus the historical averages. And this is something very few investors do, but will really give you some great insight into which sectors are expensive or cheap. Here we are on another favorite resource of mine, the sector tracker on sectorspider.com. And here you can compare the returns for a stock market as well as each sector over different periods, a week, a month, even up to the last 5 years. So I can set this for 1 year and it shows me the return on all 11 stock sectors and the market. We see that the S&P 500 is holding on to that 3.5% positive gain, with the sectors ranging from a runaway 30% gain in tech stocks to a 41% loss in stocks in the energy sector. Now, most investors will look at this and just tell you the tech sector is expensive while energy stocks might be a better deal. They just look at that absolute return, selling the stocks that have jumped and then buying the underperforming sectors. The problem is, just looking at this, you have no way of knowing if these moves are outside the norms for these sectors. And we know tech stocks have been booming for years, but we don't know if that 30% return is so far outside what we would expect that it means the sector might be ready to cool off. So what I like to do is download the share prices for each of these sector funds from Yahoo Finance. I did that here for the sectors and the S&P 500 fund for monthly data going back to 1998. And with that, I can get a rolling 12-month return for each sector. So 1-year returns for each sector over the last 20 years. And so I can compare the 1-year return on each of these sectors against that average to see if they're really so far out of the ordinary. I was doing the calculations last night, so this is still a little off from what we saw in that sector tracker, but we see that the 5.9% return on the S&P 500 is under that average 7.5% annual return measured over the last 2 decades. Now that's not too far off, so it really doesn't tell us much, but let's look at some of the sectors. Almost all the way to the right here, the XLK, which is that tech sector fund, that 1-year return of 33% is 4 times the average 8% return that the sector produces, so definitely backing up the idea that tech sectors have maybe outrun themselves. Looking at the negative returns though, we see the energy stocks. That XLE fund has produced an average 7.87% annual return over the last 2 decades, so that really puts that last year's loss of 37% into perspective. Another big loser here, the XLF financial sector fund lost 14.7% against an average return of 8.3%. So backing up the idea, the financials have fallen too fast compared to the historical data. And you don't have to use just one method to find these cheap stocks. If we use all 3 methods here, we get a better confirmation of which sectors and maybe which stocks offer better rebound potential and which ones we might want to avoid. So just going off what we've seen, we can make the case that stocks in the financials, healthcare, and energy sectors could be good bets for value. Well, we might want to avoid or just cut our exposure to these most expensive, the tech, industrials, and the consumer discretionary sectors. Click on the video to the right for why right now is a once-in-a-decade opportunity in penny stocks and how to find the best investments. I'll walk you step by step to picking penny stocks to buy. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.